Okay, ladies and gentlemen, welcome to our third episode of the Basel IV channel. After our first edition, where we gave a broad overview about all Basel IV requirements that were published by the Basel Committee, and the second episode where we had more the focus on the credit risk, especially the standardized approach for credit risk, today we will focus on a different risk type. Today we will talk about market risk, and here especially about the new standardized approach for market risk. My name is Neisen. I'm a partner in PwC in Frankfurt. I'm leading here the regulatory management practice. That means we are taking care of the regulatory challenges of our clients, and a part of that I'm also leading the global Basel IV initiative of PwC. Today I'm not alone. I have two guest speakers. One guest speaker from the UK and the other guest speaker is from Belgium. Louis, would you like to introduce yourself?
Yes, sure, Martin. So I'm a director in the risk and regulatory practice here in London, UK. I'm also the lead for FRTB. Also, adding to that, I have a global Basel IV initiative role or roles. I'm also involved in the work stream of standardized approaches and the work stream for internal models as well.
Thank you very much, Louis. Guilaume, would you like to introduce yourself as well?
Yes, thank you, Martin. I'm Guilaume Magdelyns. I'm manager in the governance, risk and compliance practice in Brussels, Belgium. And I have a role as part of the PwC Global Basel IV initiative as a Belgian representative for the market risk standardized and internal model approach. And I'm also specialized in valuation and risk assignments.
Thank you very much, Guilaume. Yeah, before we start now actually with the topic of today, the new standardized approach for market risk, let me quickly summarize you what is the purpose of the Basel IV channel. We mentioned it already in the last two episodes, but I think it's worth to mention it again. When we started the Global Basel IV initiative, we were thinking about how we can inform our clients about the latest developments from the Basel Committee. And of course, we were thinking about sending out a newsletter, both on sending a letter via post or sending one email. But in the end, we came to the conclusion that maybe that is not so up to date anymore, especially because our clients receive so many newsletters. So we thought, what would be a more modern way to inform our clients, and we came to the idea that we set up this Basel IV channel. This means every 4 weeks we are conducting a Basel IV channel live, and you can dial in via this WebEx session. Additionally to that, we record these WebEx sessions and post them on YouTube, for that you have also the possibility, when you're not able to participate in the live event, to watch it afterwards. So what is our plan for today? Let's have a look to the agenda. First, we will talk a little bit about market risk in general and what the relationship is to the rest of the Basel IV requirements, and then we go a little bit more in detail into the revised market risk framework, especially here the new standardized approach for market risk, which is also called the sensitivity-based approach. And after that, of course, we will talk about the impact of these new regulations and what the conclusions are. Yeah, the context between the new standardized approach for market risk and Basel IV, I think it's good to start with this slide that you probably will know already from the first two episodes of the Basel IV channel. The focus of Basel III, which was actually implemented in 2014 with the CRR, was mostly on capital. We had new definitions of capital instruments. We had new capital ratios that were introduced. We had additional capital buffers and also deduction positions. Apart from that, of course, we also had some new liquidity regulations, the NSFR and the LCR, and also the leverage ratio. But I think that's not fitting so much into the context, because Basel IV is mostly focusing on risk-weighted assets. Yeah, and that brings me to the point of what the focus actually of Basel IV is. As I said before, it is risk-weighted assets, and you can say many things about the Basel Committee, but not that the Basel Committee is an unfair committee, because they have no favorite risk type. So no matter about what type of risk we are speaking, Basel IV will change all approaches for the calculation of capital requirements. So no matter if we're talking about credit risk, market risk, or operational risk, and also no matter if we are talking about standardized approaches or internal model approaches, they will be all changed. And as you can see, some of these proposals coming from the Basel Committee are already finalized, like, for example, the fundamental review of the trading book or the new minimum capital requirements for market risk, where we talk about today, but also other approaches are already finalized, like the new standardized approach for counterparty credit lines, the so-called SACA, or the revisions to the securitization framework. Today, as I said before, our focus is market risk and especially the new standardized approach, but a quick overview about the whole new market risk framework will be given to us now by Luis. Luis, would you like to take over?
Yes, sure. Thanks, Martin. So the name of a fundamental review of the trading book is actually very, very applicable. Well, the reason is because there are some weaknesses with the current approach. For example, the trading book and banking book boundary, there are some weaknesses with that. For example, some banks can take advantage of that boundary, and therefore a more strict boundary is going to be in place. Some weaknesses on the VAR approach, because of the tail risk is not really taken into consideration properly. So we'll have a new measure, which is the ES, the expected shortfall. The liquidity of the trading book positions is also there some issues there. The hedging and how hedging and diversification is being considered as well. The treatment of credit risk, also there are some weaknesses with the current approach. So as I said, it's a fundamental review, the fundamental change, particularly on some banks that they don't have a trading book, but in a new world of FRTB. Some of the positions, because of the boundary of trading and banking book boundary, they might have essentially a trading book because of the strictness of which instruments go where. So that's a big change for banks, and banks need to be aware of that. For example, the standardized approach is much more complex and is sensitivity based. So that is also very, very, very important, because you'll have potentially many data issues with that as well, with that complexity. Also, as I mentioned, the new measure of internal models method, we'll have, instead of VAR, we'll have expected shortfall, or ES as we call it, and that is also a change that the internal model needs to be re-engineered and redone across the banks. Also, the standardized method will be based as a floor for the internal model's capital calculation. Yeah.
Yeah, thank you. Should we go to the next slide? Or maybe what I could mention again is, because I think it's so important, is the new banking book and trading book boundary. Currently, I have a lot of discussions with clients where we conduct workshops regarding Basel IV, or where we even conduct already the first test calculations, that they do not take into consideration the new trading book rules, because they say we are a so-called non-trading book institution. They don't exceed the materiality threshold in their trading activities, so therefore they don't have to apply all these market risk rules. But I think because of the new definition of the trading book, it might be relevant for all banks, especially because in the future there will be certain products that must be assigned always to the trading book, and other products must be assigned always to the banking book. And there are some very interesting positions that must be assigned in the future always to the trading book, like, for example, listed equity positions. So most of the banks, most of the clients that consider themselves today as non-trading book institutions hold actually equity positions in their treasury activities. So when these activities will be reallocated from treasury to trading, then definitely they will exceed the materiality thresholds, which are quite low at 15 million euros and 20 million euros per month. Then they have to fulfill also all qualitative and quantitative requirements for the trading book. So, and that will be a huge impact. And also, what we should not forget, that for the two risk types, commodity risk and FX risk, always the new standardized approach for market risk must be applied, even when these positions are allocated to the banking book. I think that's very, very important. Therefore, all banks should take care of what the impact of the new standardized approach for market risk will be. Luis, sorry, would you like to go on with the next slide? Impact and challenges.
Yeah, sure. Thanks, Martin. So some of the impacts and challenges that we'll have with this approach, I mean, especially for smaller institutions, which will be primarily on SBA, there's a higher complexity and the challenge in providing the sensitivities. So that will be a big challenge for banks. Also, the more on the processes and systems and the complexity that need to come with all those changes and many gap analysis and analysis on the changes and the impact, especially on the data requirements and the data quality, it will be a challenge. Just the change, the massive change that is required. Also on the capital charge, from the quizzes or the quantitative impact surveys, on average, the capital requirement will increase by around 40%. So that's substantial, and also the methodology of the calculation itself for the market risk capital, it is going to change. So that is a big challenge for banks. Now, coming to maybe the key area here in terms of challenges and impacts is the data availability and quality, as well as mapping of risk factors. So that will be a very big challenge, particularly the mapping of risk factors and the calculation of sensitivities, as I mentioned. I cannot stress enough. So that will be a big challenge.
Okay, thank you very much. So I think now it's time for that we go a little bit more in detail into the functionality of the sensitivity-based approach, and here Guilaume will give us some guidance. Guilaume, would you take over?
Yes, thank you, Martin. And before we start to develop into further details the component and calculation required under this standardized approach, I would like to share with you some definitions that cover the main concept. So the standardized approach is based on 7 risk classes, and some of them, like general interest rate risk, equity, or foreign exchange, are already known by banks as they are used in the current approach. However, as you can see, there is also a new category, the credit spread risk, as a response to the weaknesses of the current standardized approach by the regulator. The methodology uses other definitions, like the risk factors, which are variable impacting the pricing function for which sensitivity has to be calculated. Then you have the risk position, which are the main input for the risk charge computation formula. Fourth, you have the notion of risk bucket, which are groups of risk positions sharing common characteristics. And finally, you will have to calculate the risk charge, which is the amount of capital that the bank should hold as a consequence of the risk it takes. Now we have the definitions. We can start on the next slide to dig into more details into the approach. So we provide there an overview of the revised standardized approach, also called the sensitivity-based approach. As you can see, it's built out of 5 blocks: the delta risk charge, the Vega risk charge, the Curvature risk charge, then the default risk, and the residual risk add-on. The Vega risk charge and Curvature risk charge only have to be computed for financial instruments, embedding optionality. If we dig a little bit deeper on what is behind the delta risk, for example, it's a risk measure of the sensitivity of the bank's trading books to the regulatory risk factors that are provided by the supervisor. The Vega risk computation is pretty similar, except it reflects the sensitivity towards the regulatory Vega risk factors. Then the curvature captures the nonlinear risk. It represents the incremental risk that is not captured already by the delta risk charge. Delta, Vega, and curvature risks aims at capturing the linear and nonlinear risk of the bank's trading book's position, whereas the two other components, default risk and residual add-on, complement the setup. The default risks aims at countering the jump to default risk, whereas the residual risk add-on is added to the framework to capture more exotic risks that are not already covered by the other components. What is really new in the process is that you have to compute 3 risk charge figures for different sets of correlation scenarios, representing a normal correlation, a high correlation, and a low correlation environment. At the bottom of the slide, we describe the standardized approach within 5 main steps, covering first, the assignation of instruments to risk classes and risk factors. Secondly, the computation of the sensitivity to those risk factors. Then, the computation of the weighted net sensitivity per bucket using the prescribed risk weight. Fourth, you have to process to the aggregation of the capital charge within each of those buckets. And finally, you have to aggregate the capital charge across buckets within each classes. For those 2 final steps, you have to use prescribed aggregation formulas and correlation factors, which will recognize a certain amount of diversification across the risk buckets, across the various risk buckets. You have now in mind the main concept surrounding the new sensitivity-based approach. And I will let Luis present you the main impact on the next slide.
Okay, thank you, Guilaume. So another consideration that is very important within this regulation, FRTB, is a dependency with other regulations. For example, the PwC-SBA-Tool, which is the minimum capital requirements for market risk, the prudential valuation, the BC-SBA-239, the risk data aggregation and reporting. These are all interdependent, and there are touch points and overlaps with the FRTB regulation. So this overall will give us a larger universe of risk factors. The volume of data and the quality of the data need to be looked at more closely. There will be a larger backtesting requirements coming out of these regulations overall. The contribution of the netting and the hedging and how they interact is also a consideration and an important and a key factor. The data management needs to be looked at in more detail, and we'll have P&L volatility kind of considerations as well.
Thank you. Should we go to the conclusion?
Yes. So the conclusions of these and the final conclusions and remarks on the FRTB framework, if I can summarize it, I would say that this is a fundamental, as the framework, as FRTB actually describes, the fundamental review of the market risk capital charge, and because it's so fundamental, you have to make adjustments and changes within your IT infrastructure, within your systems, within your processes. And that is something that will happen and needs to happen, and it will be an issue. Another one is the reporting needs that need to come out of that we are coming out of this regulation. You need to report, even if you are on internal models for a desk, for example. You need to also report your standardized capital charge as well, regardless. So that is an additional and prescribed by the regulation reporting that needs to happen. And of course, you need to have the data to support that, the processes, and the infrastructure and systems in place. Also, there is a very prescriptive and quantitative method between the internal model / standardized capital charge, and that is really prescribed by the regulator. And there are a few tests: the P&L attribution, the backtesting that need to happen in order to understand if a desk can utilize the internal models, or they fail and they need to go and default to standardized calculation. So the other consideration that I should stress here is the increase in capital due to this new regulation. Some individuals in the industry that understand the regulation are saying that actually it might not increase by only 40%. It might actually go up to 400% increase, and that's quite scary, I have to say. Lastly, I have to mention maybe one very important point, and conversations which I have had with clients. They are very worried about the reorganization of desks and their business units. Ultimately, this will need to happen. Some desks will need to be scaled down, or they need to be decommissioned altogether, or they need to merge with another desk, depending on if it makes sense to actually operate with, if they have a high capital charge for that specific desk. So about restructuring, optimizing the desk and the units and the business is something that will be at the agenda of many CEOs, I have to say.
Mm-hmm. Thank you.
Okay, so the last slide is about an SBA tool for standardized calculation of capital. So PwC has developed a tool internally based on the technologies, so basic free technology like Microsoft Access and Excel and VBA that can perform the calculations and benchmark if there are some calculators internally in some banks. This tool can be utilized to potentially even benchmark those calculations. It is a very flexible tool that has a capability to absorb the data from the bank, the sensitivities and all the data that is required for the calculations and all the parameters, and then crunch the numbers as per what Guilaume described the calculation is and all the steps, and then reports on what the capital charge per desk and bank level are. Is a very flexible. You can do what if scenario analysis as well. It calculates all capital charges, the delta, the Vega, and the curvature as well. And it's a very, and has been validated as a very solid tool. It can run huge amounts of data. So we are very happy that we developed such a tool internally.
Yeah, thank you very much, Luis. Thank you very much, Guilaume. Now, in the end, I would like again to support what Luis just mentioned about the tool and why it is so important to perform right now in this moment the test calculations. I think there is absolutely no doubt that Basel IV and also especially the fundamental review of the trading book will have a huge impact on institutions, and not only in the European Union, where traditionally all the Basel rules are adopted in a regulation, but also on a global level. And when you look to the impact that these new rules will have, you can make a differentiation between strategic implications, because we can definitely assume that the risk-weighted assets will increase, both on the credit risk side and also on the market risk side. What we still don't know, and therefore it's so important to perform these test calculations, how big the increase is. We performed as PwC on a global level quite a lot of these test calculations with quite different kind of clients. We had large investment banks, we had mid-sized banks with a small trading portfolio, we had small banks that had quite big trading activities, so really a lot of different clients. And what we must say at this moment that the impact actually highly depends on the individual structure of the portfolios of these clients, especially when we talk about the trading portfolio. Because on the one hand side, the big advantage of these new Basel IV rules, and especially the fundamental review of the trading book and this new standardized approach for market risk, is that it is more risk sensitive. But that means, of course, if you have a risky trading portfolio, the capital increase will be huge. If you have a plain vanilla portfolio with more or less only some interest rate trades, then of course the increase will be not so big. In some cases where you can use now much more hedging in diversification effect, maybe the capital requirements will decrease. But you will know if you have an increase and how the increase is and how, or if you have a decrease, you know only if you perform these test calculations. So I only can repeat what Luis just said. It's very, very important that you perform these test calculations, and we as PwC will be very, very happy if we can support you with that. And the tool we developed actually works with quite a lot of different IT systems. It's access-based, so to arrange the interfaces with your front office or your back office systems will be a quite fast thing and will cause not so many problems. Yeah, this is the moment where I have to thank very much Guilaume and Luis for their contribution. I think it was a very, very interesting presentation. Before I say goodbye this time to you, I would like to mention that we are also currently conducting our regulatory roadshow on a European level. This means that in the next month we are going to visit the locations Amsterdam, Athens, Bucharest, Dublin, Istanbul, London, Luxembourg, Madrid, Milan, Paris, Riga, Stockholm, and Vienna. And actually I was already yesterday on the roadshow in Warsaw, and I think it was quite a big success. We had a lot of discussions, and I think everybody realized that Basel IV is a very, very important topic for the future. So I would be very happy if we could invite you to these regulatory roadshows. If you need exact dates when it will happen in your territory, please do not hesitate to contact us. You can contact me, Martin Neisen, Luis, or Guilaume. We will be all happy to help you. But of course, you can also contact your local Basel IV contacts of PwC. We have them here also included in this presentation, and when we upload this presentation on YouTube, we will also write all the contacts down in the comments for the YouTube movie. So again, thank you very much, and we all wish you a happy weekend. Hope to see you soon. Bye-bye.